a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about small cap ETFs and whether they are now too cheap to ignore. So we know that the rally this year has been led mainly by mega cap tech stocks. But recently, over the past few weeks, we have seen some broadening of the rally, and small caps in particular have rebounded strongly, particularly after we got those cooler than expected inflation and job markets reports. And despite this recent outperformance, the S&P 500 index of small companies is still up just about 3% this year versus the S&P 500 index, which is up more than 20%, and the Nasdaq 100 index is up about 48%. So this underperformance of small cap stocks, they are trailing the S&P 500 index by the widest margin in 25 years, according to the Wall Street Journal. And these stocks now are historically cheap relative to their historical typical valuations. According to Bank of America, these stocks are trading at a 19% discount compared to their historical valuations, whereas the mega cap stocks are trading at an 18% premium. So this underperformance earlier this year was driven mainly because of sticky inflation, rising interest rates, and worries about an economic slowdown or a recession, and also because there are many banks in this space. There are many small companies which are banks, and we know that banks had a meltdown earlier this year and they have been underperforming. Now, these companies in general have low pricing power compared to larger companies. Like tech giants have a lot of pricing powers, and when inflation is high, those companies with pricing power can pass on higher costs to their consumers, whereas smaller companies cannot, and that results in low margins for these companies. Also, a lot of these companies issue floating rate debt, so that is why they are more vulnerable to higher interest rates. Also, about 30% of these companies are unprofitable, so that is why they are more sensitive to economic slowdown. If the economy falls into a recession and these consumers cut back on their spending, then these companies would be hurt the most. And in general, these stocks are more volatile compared to larger stocks. So if you're interested in small cap stocks, instead of trying to bet on some companies, probably it makes more sense to look at very broad small cap ETFs, so you get a broad exposure. So if you believe that these stocks are too cheap to ignore, then maybe you can take a look at these ETFs. So the first ETF I'm highlighting is the most popular ETF in the space, and the ticker symbol is IJR. It is by iShares. It tracks the S&P Small Cap 600 index, and as the name suggests, it holds 600 stocks, 600 small cap companies, very popular with 68 billion in assets and ultra cheap with just 6 basis points in expense ratio. This is, as I mentioned, IJR. Then you can read our research report articles, and then using the link, you can go to the iShares webpage for this ETF and learn more. You can look at the portfolio, what it holds exactly. So a lot of small companies which we are not very familiar with, but it makes more sense to look at the exposure. As I mentioned, these ETFs have a lot of exposure to banks and other financials, so almost 19% exposure to financials, and then industrials and consumer discretionary stocks, information technology is just about 13%. The second ETF, which I'm highlighting, tracks the very popular Russell 1000 index. The ETF is IWM. This is also a very popular ETF with about 56 billion in assets, and this charges an expense ratio of 19 basis points. And as the index suggests, it holds about 2,000 stocks, so more broad, more diversified compared to IJR, but slightly pricier. So again, let's go to the quote page on Zacks.com and look at what it holds. So here's the quote page, and using the link, you can go to the iShares webpage for this ETF. And let's take a look at its holdings and portfolio. So holdings, of course, not very familiar, slightly different kind of exposure. Financials are the second they get the second highest weight, about 17%. Industrials, and then healthcare. Information technology is again about 14% of the portfolio. The third ETF that I'm highlighting is actually the best performing small cap ETF year to date. And this is from the Pacer Cash Cows series. This is CAF, very interesting ticker symbol. So this holds 100 companies from the S&P Small Cap 600 index and then excludes financials. So that is one of the reasons why why this ETF has done well. And also then it selects those 100 companies by free cash flow and weights them also according to free cash flow. So you get high quality companies from that index. This series of cash cows, ETF cows and CAF and others, which I have covered in a previous video, they have been very popular with investors this year and have attracted a ton of inflows. So this ETF now has close to 5 billion in assets, slightly pricier compared to other two, and charges 59 basis points. And again, to learn more, let's go to the quote page on Zacks.com. And I had done a podcast with the provider some time back. You can listen to that podcast. We have published a guide also because these are so popular. Maybe take a look at our guide, and using the link, you can go to the Pacer webpage for this ETF. The webpage will describe what exactly is meant by free cash flow, how it is calculated. So it makes sense to look at all that before you decide to invest. And looking at the portfolio, you will see no financials. Consumer discretionary gets a ton of weight, about 36%. And then industrials, energy, consumer staples, and other sectors. Now, on the last slide, I have the comparative performance of these ETFs versus the S&P 500 index. So as I mentioned, CAF is the best performing ETF. Of the three, it is up about 23% year to date, whereas the S&P 500 index is up about 21%. And the other two ETFs, popular ones, IJR and IWM, they are up just about 3 and 4% respectively year to date, even despite the recent rebound. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer. Also, make sure to subscribe to our YouTube video channel so that you do not miss anything. And I will see you next week.